In 1965, a young man from Omaha took control of a struggling textile mill called Berkshire Hathaway. Nobody could have predicted that 6 decades later, that same man would be handing over the reins as the most successful investor the world has ever seen. This isn't just the story of Warren Buffett's exit. It's the story of 60 years of wisdom, compressed into the lessons that built an empire, lessons that apply just as much to a small SIP investor in Mumbai as they do to Wall Street's biggest fund managers. If you're an Indian investor watching Nifty swing wildly, wondering whether FNO trading is the shortcut to riches, or trying to figure out if the next dip in Sussex is a buying opportunity, stay with me. Because everything Buffett learned in 60 years, he's now handed off to Greg Abel. And what he leaves behind isn't just a company worth hundreds of billions of dollars. It's a playbook. Buffett didn't start as a genius stock picker. He started as a student, literally. Under Benjamin Graham at Columbia, he learned one core idea: buy businesses, not tickers. A stock isn't a lottery number blinking green or red on your screen. It's a piece of a real business with real earnings, real debt, and real management decisions. This is the first lesson, and it's the one most retail investors in India ignore. SEBI's own data has shown that a staggering majority of individual FNO traders lose money year after year. Why? Because they're not investing, they're gambling on short-term price movement. Buffett's first 60-year lesson is brutally simple: the stock market is a device for transferring money from the impatient to the patient. Buffett famously avoided technology stocks for decades, not because he thought they were bad businesses, but because he didn't understand them well enough to value them with confidence. This is his circle of competence principle. Know what you know. Know what you don't. For Indian investors chasing every hot IPO or jumping into crypto and options because a YouTube thumbnail promised 10x returns, this lesson cuts deep. Buffett would rather sit on cash, and Berkshire has sat on nearly $400 billion of it, than deploy money into something he doesn't fully understand. Translate that to your own portfolio. Before you buy that small cap stock because your college WhatsApp group is hyping it, ask yourself, do I actually understand this business? Or am I gambling in a casino wearing an investor's costume? One of Buffett's most repeated metaphors, borrowed from Graham, is Mr. Market, an emotional business partner who shows up every day offering to buy or sell you shares at wildly different prices depending on his mood. Some days he's euphoric. Some days he's panicked. Your job is not to be influenced by his mood swings. Your job is to take advantage of them. This is exactly what plays out on Dalal Street every single day. Nifty drops 2% on panic selling, and retail investors dump their SIPs in fear. Then it recovers, and the same investors chase it back and at higher prices. Buffett's lesson: volatility is not risk. Volatility is opportunity if you have the emotional discipline to sit still. Buffett's Coca-Cola investment, made in 1988, is still held today. His Apple investment, built over the last decade, became one of Berkshire's largest holdings. Neither of these were quick trades. They were multi-decade commitments. For an Indian retail investor, this lesson translates directly into SIP investing. A SIP isn't exciting. It doesn't give you the dopamine hit of an options trade. But compounding, quietly and patiently, over 15 or 20 years, is what actually builds wealth. Buffett has said it plainly: his fortune came from a combination of living in America, good genes, and compound interest. Time in the market, not timing the market, is the entire game. In recent public comments, Buffett has grown increasingly vocal about what he calls casino-like behavior in modern markets, the explosion of short-dated options trading, zero-day expiries, and prediction markets that let people bet on outcomes with the same thrill as a Vegas slot machine. He's warned that markets are increasingly being used for entertainment and adrenaline rather than genuine capital allocation. This warning lands especially hard in India, where SEBI has published data showing enormous losses among individual traders in the futures and options segment. The rise of retail FNO participation isn't a sign of financial sophistication. Buffett would say it's a sign of a casino dressed up as an exchange. His final years at the helm have been partly spent sounding the alarm on exactly this kind of speculative frenzy. By early 2026, Berkshire Hathaway was sitting on close to $397 billion in cash and equivalents, an almost unthinkable war chest. Critics have asked why Buffett wasn't deploying it. But that hoard is itself a lesson. Sometimes the smartest move in investing is doing nothing. Waiting for a fat pitch, as Buffett calls it, rather than swinging at every ball thrown your way. For retail investors, this means resisting the urge to always be in the market. Cash isn't wasted capital. It's optionality. It's ammunition for when real opportunity, not hype, appears. As Buffett has stepped back, Greg Abel has taken the reins as CEO, a transition years in the making and carefully telegraphed by Buffett and Charlie Munger long before it happened. Buffett didn't try to be irreplaceable. Instead, he built systems, culture, and a management bench deep enough to outlast him. That's a lesson beyond investing. It's a lesson in building anything that lasts. Whether it's a business, a portfolio, or a legacy, the goal isn't to be indispensable. The goal is to build something durable enough to survive your absence. At Berkshire's most recent annual shareholder meeting, an AI-generated deepfake incident became a stark reminder of how technology can now impersonate even the most trusted voices in finance. It's a fitting final warning as Buffett exits the stage. In an era of AI-generated content, verify your sources. Don't trust financial advice, including videos like this one, blindly. Cross-check, read the filings, understand the business yourself. Warren Buffett didn't just make money. He made a philosophy accessible to ordinary people: patience over panic, business understanding over blind speculation, discipline over dopamine. 60 years is a long time to prove a single idea. But he proved it. Value investing, done with patience and discipline, wins over the long run. Whether you're managing a SIP in Mumbai, watching bank Nifty candles in Bangalore, or holding Berkshire shares in New York, the lesson is universal. Buy quality. Understand what you own. Be patient. Ignore the casino. If this video gave you value, subscribe to Master Investor Mindsetter for more deep dives into the minds of the world's greatest investors. Drop a comment below which Buffett lesson resonates with you the most. See you in the next one.